Silver, it's trading at $93.66. By the time gold gets back up to 5,500 and change, and silver gets back up above 120, which it should happen this year, the biggest mistake that people are going to make in this space is selling and thinking they did great. I haven't sold anything, not a share. I haven't sold a single share or an ounce of gold or an ounce of silver. You know, the East has been buying gold for years. The Chinese, the Indians, yeah, they've been buying, and they're going to keep buying. Gold's at 5,250. How is that early? I mean, I started buying gold for myself and my clients when it was under $300. Now the money is flowing out. And what do you think happened today? Tech stocks got killed today. The air is coming out of the AI bubble. What went up? Gold and silver. And gold and silver mining stocks. I knew eventually Wall Street was going to figure out what I already knew. It's happening now. The institutions are embracing gold. As I'm looking at it now, at about 6 minutes before 5 o'clock on the East Coast time, gold is up $94.80 on the day. And it's last traded at $5,278.70. This is the highest close ever for a week or a month for gold. I don't know if it's the highest one-day close. I forget where it was, when it was got up to 500. But it's definitely the highest weekly and monthly close. Silver is up $5.50 right now on the day. It's trading at $93.66. This is for sure the highest monthly close, but it is not the highest weekly close. It's actually the second highest weekly close. We managed to close higher than this 1 week, a few weeks ago, before, on the way up before the big collapse. But we're now, solidly above $90 on silver. Don't focus on the fact that we did get to 120. Focus on where this rally started. A year ago, silver was like $30, so it's more than tripled. In fact, I jotted down the returns on gold and silver so far for the year, 2 months in. Gold is up better than 21.5%. That's, 10% a month. If it does that every month this year, the price of gold will more than double on the year. Now, I don't expect that higher return, but I would not be surprised if that's what happened. It's not completely out of the question.
Record highs feel euphoric, but the real story is the velocity of this move. As Peter Schiff points out here, a 21.5% gain in 2 months annualizes to extreme territory, and historically, gold sustaining 10% monthly gains signals liquidity stress somewhere else in the system. Silver tripling from $30 to above $90 isn't just momentum. It reflects capital rotating out of fiat-sensitive assets. When metals outperform this aggressively, it often coincides with falling real yields or cracks in equity leadership. The question isn't whether this is impressive. It's what's breaking beneath the surface. And what Peter Schiff says next reframes whether this is late cycle euphoria or still early innings.
Silver is up almost 30% so far this year in 2 months. 30% increase in the price of silver. Now, the mining stocks have done better than gold and silver, but not nearly as much as you would think. So the GDX is up 35% on the year, and the GDXJ is up 38%. These are returns in just 2 months. Now, as I predicted on my prior SchiffGold market wraps and on my regular podcast, I was saying that I believed the GDX and the GDXJ, those are two indexes of gold mining stocks, would hit new highs before gold and silver hit new highs. And that's exactly what has happened. In fact, the GDX is at an all-time record high, so it's never traded this high. But the GDXJ still has a long way to go to get back to where it was in 2011. Now, I think it will take out that high before the end of 2026. But for now, it's just the high since 2011. But for the GDX, it is an all-time record high. But by the time gold gets back up to 5,500 and change, and silver gets back up above 120, which may take a little longer, but it's still going to happen, and it should happen this year. But by the time the precious metals get back to those record highs, the mining stocks, I believe, will be way above where they were the last time, gold was 5,500, which is why you should still be buying these stocks.
Miners hitting highs before metals sounds bullish, but it also signals speculation creeping in. As Peter Schiff argues, GDX up 35% and GDXJ up 38% in 2 months is leadership. Yet juniors still sit below 2011 peaks, revealing how deep the prior destruction was. Historically, miners outperform latent strong metal cycles, but they're also more volatile when liquidity tightens. Record highs in GDX, while gold hasn't reclaimed $5,500, suggest traders are front-running expectations. That's confidence, but also leverage. Peter Schiff believes this gap widens further, and that's where risk and reward both accelerate.
All I can say is just keep on buying. Don't think the prices are too high. That was a big problem for a while. SchiffGold customers were stuck on the fence. When gold was at 2,000, they were afraid to buy. And then they were afraid to buy 3,000. Well, now you're at 5,200. And, soon you'll be afraid to buy 6,000 and then 7,000. At some point, nobody will be afraid to buy because there'll be nothing but greed. But I think that's not going to happen for quite some time. And I think prices will be much, much higher. Again, we are still early. People might say, well, how can we be early, Peter? Gold's at 5,250. How is that early? I mean, I started buying gold for myself and my clients when it was under $300. So clearly, if it's gone from 300 to, close to 5,300, how can you say it's early? Well, here's the reason I think it's early. Central banks didn't really start accumulating gold till a couple of years ago. That's when they started, really like 2004, right? That's really when it began. When I first started buying gold, central banks were selling it. That's one of the reasons it was so cheap. Central banks were getting rid of their gold. They just started to accumulate it.
Price alone doesn't determine whether you're early. Positioning does. Peter Schiff reminds us central banks were net sellers in the early 2000s, and today they're net buyers, flipping a 2-decade trend. That structural shift matters more than whether gold is $2,000 or $5,000. When official sector demand turns persistent, it tightens long-term supply dynamics, but investors should also remember sentiment cycles. Greed phases historically compress future returns. The discipline isn't blind buying. It's measured allocation aligned with risk tolerance. Peter Schiff's early argument hinges on who is buying now, and that changes the cycle math.
So we're early in this de-dollarization process because all these central banks have a lot of dollars they need to unload. It's going to take years and years and years. Plus, they keep getting more. We're spitting out dollars. We have these huge trade deficits. So as fast as the world can get rid of dollars and buy gold, they get more that they got to get rid of. So we're early in the central bank de-dollarization process, and a lot more gold is going to get bought. We're even earlier in the private investors. Yes, the East has been buying gold for years. The Chinese, the Indians, yeah, they've been buying, and they're going to keep buying. The difference is now the West is going to get in on the action because the West has been selling gold. American investors, all 2024, pretty much all 2025, were net sellers of gold. Just look at all the net redemptions that were coming out of the ETFs. So private investors in the West, which are probably Europe, Western Europe, North America, right, particularly the United States, I think 2026 is the beginning. Maybe a little bit at the end of last year, but this year, 2026, is going to be really the first year where private investors in the U.S. decided to allocate money to gold and silver and gold and silver related equities. So this is year one. This is the ground floor.
De-dollarization isn't a headline. It's a balance sheet reality. Peter Schiff frames this as early innings, and he's right that persistent US trade deficits mechanically export dollars abroad. When foreign central banks diversify reserves, even a small percentage shift toward gold can move prices dramatically because the gold market is tiny relative to global FX reserves. ETF outflows in 2024 to 2025 show Western retail hasn't fully returned yet. If flows reverse in 2026, marginal demand could amplify volatility. Peter Schiff's ground floor claim depends entirely on whether Western capital finally rotates, and that's the pivot to watch.
Yes, I've been buying these stocks for 20 years, right? I was early because I knew this was going to happen. I knew eventually Wall Street was going to figure out what I already knew. And, I look at some of my gold stocks. Of course, I wish I had all my money in these, but I have a lot of stocks now that are 15, 20x what I paid for them. Amazing. Now, my worst performing stocks are only 3 to 4 times what I paid for them now. I have a lot of stocks that are 5, 6, 7. But it is amazing now when I look at some of these prices and I look back at my earliest cost basis. But I was way ahead of my time. Nobody was talking about this. I'm not saying nobody. Yes, there were people, but people, in the mainstream, Wall Street, people that, were highly regarded in the investment industry, managing big money, right? Nobody was doing this, right? I was kind of like a lone wolf in this approach. But this is the first year that I hear the mainstream, you got to be in gold, you got to have allocations of gold. And now, of course, as I said earlier, with tokenization and gold, now being integrated into the blockchain, which is, of course, I've always said, I've been saying for years that, the only thing that it makes sense to put on a blockchain is gold. That's it. And so it's happening.
When the mainstream finally agrees, early adopters are already sitting on 15 to 20x gains. As Peter Schiff points out here, being early means enduring years of skepticism before institutions rotate in. Historically, once major asset managers begin recommending allocations, much of the easy multiple expansion is already behind us. The tokenization angle is interesting, but blockchain integration doesn't change mining costs, reserves, or geopolitical risk. Investors need to separate narrative adoption from valuation reality, especially with forward PIs in parts of the mining sector expanding quickly. Peter Schiff suggests this is validation, but validation and peak enthusiasm often arrive closer together than people expect.
It's happening now. The institutions are embracing gold in crypto. They're embracing it on Wall Street. There's tremendous demand that is coming for precious metals, and it's just starting, just now starting. That's why I've been saying the biggest mistake that people are going to make in this space is selling and thinking they did great. I haven't sold anything, not a share. I haven't sold a single share or an ounce of gold or an ounce of silver because I think there's so much more upside coming. Because I understood that this was going to happen. I've been preparing for it for longer than I thought. Yes, when I started buying gold, back in the 1990s, right? I thought we would have had a dollar crisis sooner. We haven't even had it yet. Now, what's happening in gold now, to me, is a real indicator that it's coming. It's coming soon. And that's another reason why I don't want to sell anything. Because, what am I going to buy? I want gold and silver. And these mining stocks are so ridiculously cheap. Now, with my new money, yes, I haven't been buying more gold stocks. I kind of wish I did, considering how much they go up, but I'm just so over allocated personally that I've been buying more emerging market stocks. I added to my energy stocks, which I made great buys there.
I haven't sold anything sounds disciplined, but concentration risk always deserves scrutiny. Peter Schiff emphasizes conviction, and long-term conviction has rewarded him. But history shows even strong bull cycles correct 20 to 30% along the way. Institutions entering doesn't eliminate volatility. It often increases it as leverage builds. Portfolio allocation matters more than belief, especially if Fed policy shifts or real yields spike after a surprise CPI print. Emerging markets and energy additions suggest some diversification instinct is already there. Peter Schiff frames holding as strength, yet risk management, not loyalty to a thesis, ultimately protects capital.
They all hit 52-week highs this week, a lot of the oil stocks I have. But I had to diversify out of gold and silver stocks because I had so much. But I still think for a lot of people, they don't have enough. Most people need to keep buying. Even though the prices have gone up, they're cheaper now than they were when I was buying them. If you look at the price of gold and what they're likely to earn in the coming years, the stocks are a real bargain. But, you know, all the foreign stocks, it's not just my gold stocks. I mean, I have utilities in Europe that have doubled and tripled. I mean, people are moving into these non-U.S. assets now that have been cheap for many, many years. That's why we were buying them. This is a major shift out of U.S. dollars. Central banks are going out of U.S. dollars and into gold, and private investors are going to be going out of U.S. dollars and out of U.S. stocks, which have been overvalued for years. And for years, it didn't matter that they were overvalued because the money kept flowing in. Now the money is flowing out. And what do you think happened today? Tech stocks got killed today. The air is coming out of the AI bubble. What went up? Gold and silver. And gold and silver mining stocks, foreign stocks. That's where the money is flowing. It's going out of risk assets, tech, and crypto, and going into more conservative, real-world stores of value like gold and silver and dividend-paying foreign stocks. So
one bad tech day doesn't automatically confirm a lasting capital exodus. Peter Schiff highlights rotation, and short-term flows do show pressure in mega-cap tech when yields rise or AI expectations cool, but sustained sector shifts require multiple quarters of earnings divergence, not a single session. The Nasdaq's forward PE remains elevated compared to energy and materials, yet capital reallocations historically unfold gradually, often around Fed pivots or recession signals. Investors should watch fund flow data and breadth indicators, not headlines. Peter Schiff sees structural rotation. The next data release will test whether this is trend or tremor.
Once again, I'm going to give you the same advice that I gave a week ago on the SchiffGold Friday market wrap. Don't wait for Sunday night when the Chinese are awake and buying. Buy any additional gold and silver now before they have a chance. Buy it Friday night, buy it Saturday morning, buy it Saturday night, buy it Sunday morning.
Urgency around weekend buying often says more about sentiment than supply. Peter Schiff implies overseas demand could gap prices higher. An Asian market opens can create short-term volatility. But long-term investors shouldn't anchor strategy to intraday timing unless liquidity conditions are extreme. Gold trades globally 24 hours, and spreads can widen on thin weekend sessions. Acting out of fear of missing a Sunday move risks emotional execution over disciplined allocation.